Hey everybody, Ryan Carson here. I wanted to talk to you about businesses to be purchased or sold. And so there's two different ways that could be done. If the business is an incorporated business. So if the business is not incorporated, if you're buying a partnership or you're buying a sole proprietorship, you really only have the opportunity to do an asset purchase or sale. However, if you are an incorporated business and you want to sell the business as a corporation, you could do that by two things. You could sell the assets of the corporation, not unlike the example of the sole proprietor and partnerships, or you could actually sell the shares of your corporation. So why would you do one versus the other? Most of the time, most buyers prefer asset purchases. The reason they do, the primary reason would be they're trying to limit and carve out of the business only the assets of value or deemed value and avoid the mistaken or accidental acquisition of liability. So what I mean by that is if I was buying from you and I wanted to do an asset purchase and I wanted a very definitive list of 100 items, inventory, equipment, goodwill, client list, all within this list of 100 assets, my agreement would be very detailed to say these are the 100 items I'm buying. Anything else I'm not buying, any other assets I'm not buying, and most importantly, I'm not attracting any liability of the business if the liability is not affixed in any way to those assets I'm buying. On the flip side, sellers of corporations can take advantage of what is called a share sale, and sellers prefer a share sale if they can qualify for what is called Lifetime Capital Gains Exemptions. Lifetime Capital Gains Exemptions, that's a tax term that, as a lawyer, I'm not going to explain tax to you, but your accountant could in greater detail. But if you've done your corporate and tax planning properly and efficiently, and you haven't used any of your Lifetime Capital Gains Exemption, you can essentially sell your business shares. You could qualify to utilize your Lifetime Capital Gains Exemption. Right now, that Lifetime Capital Gains Exemption, which is essentially a tax credit on the value of the business sold, the Lifetime Capital Gains Exemption is now at 1 1/4, so $1,250,000 for this year. So if I, as a business owner, am selling my business and I've never previously used my Lifetime Capital Gains Exemption in any of my tax planning or tax returns up to this date, I could essentially pay little to no tax or significantly shelter any tax requirements by doing a share sale, thus keeping the majority of my $1.25 million sale price. If I didn't do that share sale and I didn't qualify for the share sale and the Lifetime Capital Gains Exemption, the problem would be if I sold it as an asset sale, I have to claim and remit the actual 1.25 sale on my tax returns and likely pay a very hefty tax on that 1.25 because it's going to put me into a high tax bracket for marginal tax rates. You definitely want to look into and get advice from your accountant first and lawyer second on can you benefit from a share sale and the Lifetime Capital Gains Exemption, and if you can, what do you need to have structured and negotiated with the buyer to benefit from that to obtain those opportunities. The other thing that you should do as a seller is do not wait until the closing date or 6 months from a closing date or even a year. You need to do certain things in your planning at least 2 years before an eventual sale. There needs to be this time period for planning to be in place for at least 2 years so that you don't get caught on a CRA review to say, hey, you guys did a filing saying you're entitled to the Lifetime Capital Gains Exemption. Our review shows no, you did not meet the required steps to get qualification, and thus now you have to pay tax. So it's very important to, number one, know what is the difference between an asset and a share sale, and when would I want to know that it's important to gain the benefits from a share sale and a lifetime capital gains exemption. In a share sale model, you need to do some planning ahead of time, and that planning should start at least 2 years, if not before 2 years, on any potential business sale. So if you need help with anything, let us know here at 𝗞𝗲𝘆